Hello everyone, welcome to maybe a demonstration, you might say, of how we might set up a variance analysis problem in Excel and work through it, demonstrating all of the variances that we might look at and even how they might be used in the T account process. Over here on the left, we have the standard that we come up with. All right, this is what we should have happen when we make our product. We should use 6 gallons of direct materials, and we plan on paying $4.30. We should use 4 hours per product, and each of those hours should cost us $24. We should use 2 machine hours, and that's our only variable overhead cost pool. That has to do with machine hours for each product, and each of that would be $6.50, and our fixed overhead would be $22,000 per month. Our selling price is $180 for our product, and we plan to sell 600. So our static budget is based around 600. Well, because we are likely not to hit exactly 600, we're going to create a flexible budget for a particular accounting period, in this case, November. So we're going to do a flexible budget at 500, 550, and 600. So 600 is what we are planning, but just in case we don't hit that, we're going to have a flexible budget set up. So if that's the case, sales for 500 would just be 500 times 180. Our direct materials is going to be the 500 times 6 gallons times $4.30. Direct labor is going to be 500 times 4 hours times $24. 500 times 2 machine hours times $650. Subtract those all, we get our contribution margin, and then we put our fixed overhead at $22,000, which is the same no matter what. So what changes with 550? Now you use 550 instead of the 500. And then we do the same thing with 600. They all change because they are per unit as variable costs and sales. Now, we actually made 550, okay, during the accounting period. So, and the actual costs are given over here. We purchased 3,200 gallons, $4.25 a piece, okay? So if we want to know what the total of that is, we can just do our little math. We used 3,400 gallons production. Now, just a quick reminder, how much we purchase and what we use are different. We cannot do our variances together. We can't add them together. So this is a situation where we're going to do the purchase price variance, and we're going to do the usage or quantity variance, and we're not going to add them together. We're just going to do them separate. Okay? Direct labor, we use 2,400 hours, I should say, and that costs $55,200, about $23 per hour is our actual cost. And then variable, we used 1,160 machine hours, and the cost was $63.70. Okay, and then our fixed overhead actually for the month was $23,640. So if we build our variances, and again, you can set these up however makes the most sense to you. I like to do them horizontally this way, with the actual on the left, standard on the right. Okay, but again, there's different ways you can do them as formulas, where you take the difference between the prices and then multiply by the quantity. Okay, however you set it up, it makes the most sense. So if the actual price and actual quantity, 13.6, just like I calculated over here. We purchased 3,200, 425. The standard, okay, is 430, right? $4.30 and 3,200, right? 3,200 is the actual quantity. So the difference is 160. That's favorable, right? We spent less, 425, than 430, less than we planned. So we've got a favorable variance. I don't really care about the minus or plus. I care that you can tell me it's favorable or unfavorable. That's our direct labor rate variance. The only reason that happened is because we paid less than what we planned. So then we do usage variance, and we don't use the same thing. This is separate and this is separate because they're a different amount used than purchased. So the actual standard quantity and standard price comes right from the flexible budget. What should we have used in direct materials to make 550, which is how many units we actually made for them for the month of November? 14,190. So literally, it's the same way we got the flexible budget, which is often why we create the flexible budget first. So we'll have that. And then this is the actual quantity, okay, times the standard price. All right, so the only difference is in the quantity, right? So the actual quantity was 3,400 used, not purchased. That was 3,200. 3,400 was what we used, all right, when we should have used 550 times 4, okay? I'm 6. I'm looking at labor instead of materials. 550 times 6. So how we got that was take the 550 times the 6 times $4.30. Then we just take the 3,400 times $4.30. That's unfavorable. We used more quantity than we were supposed to. And that we lost $430. That's unfavorable. That's our efficiency or quantity variance, however you want to refer to it. Now, what would that look like in our T accounts? Okay, if we use standard costs to actually make journal entries, okay, the actual price and the actual quantity would be a credit to accounts payable. That's what you're going to actually have to pay. All right? But you're going to debit the $13,760 to raw materials. You're going to use the standard cost. And the difference is going to be 160 in the price variance. And credits are favorable, debits are unfavorable. Then when we move it into our raw materials, okay, we're going to do so at the standard quantity and the standard price. So we're going to and our variance, Bruce's variance, is going to be the 430 to make it balance. Oh, sorry about that. This is going to be the 14,620. So there's a credit of 14,620, 2 debits that actually equal. So what ends up in work in process? The standard, the flexible budget, however you want to think about it. So we have dealt with any variance from what we planned already. It's not going to go forward and affect any of our other numbers. It's already been taken out. Same thing would happen with labor or things like that. But that's a quick illustration of how the journal entries work with this. Okay, moving on to the rate variance for direct labor. Okay? Again, putting the actual price of $55,200, right? That's what they actually paid, and the standard. All right? So we're going to take 550 times 4 hours. I'm sorry, we're going to take the 2,400 hours, actual number of hours used, but now instead of multiplying it by the 23, we're going to use 24 that was standard. That's going to get us 57,600. So we're going to save basically $1 on every hour, so that's $2,400 of favorable variance because we spent less than we planned. Now, because there's no leftovers, there's none of that inventory issue with labor, that number there that we already have just needs to be compared to our standard quantity, okay, times the standard price, which comes right from our flexible budget, $52,800. $550 we actually made, 4 hours, $24. So we now have the two numbers. We can just take the difference, 4,800, because our actual quantity here is higher than our standard quantity. So we used 2,400 hours, and we should have used 2,200. 550 units, each using 4 hours. That's 2,200. But we actually used 2,400. So we're over by a couple hundred hours. That means $4,800 of over or unfavorable. So these can be added together. We take the total and we're at 2,400 unfavorable. So we have a favorable price variance, an unfavorable quantity variance or efficiency variance that leads to an unfavorable total variance. So how would we do the variable overhead? Okay, so the actual price times the actual quantity would be $63.70, right? That is what it actually cost. And our standard price would be, right, is our $6.50. So we'd use so that is what standard price is times the actual machine hours. So the difference between those two so that's a favorable because we spent less than what we planned per machine hour. Now we can use this same thing again. We just have to calculate what would be, get our flexible budget. Variable overhead would be $71.50. That's our standard. And then we just take the difference. And lo and behold, we are unfavorable because we should have used 1,100 hours because we made 550 and each should take 2 machine hours, 1,100 hours, and we used 1,160. Not a lot, but some amount of over. So that's unfavorable. Okay. And then our actual fixed overhead is $23,640. The budget is $22,000. our spending variance is unfavorable. We went over our budget. And our applied would be this formula. 22,000 divided by 600. That's what we planned to sell. Times what we actually sold. I'm going to go ahead and round that. And I'm not too worried about whether that's favorable or unfavorable, because remember, it's really not controllable by the manufacturing process. All right, but we applied less than we planned because we made 550 instead of 600 that we planned. That's the only reason. So that's due to making and selling 550 instead of 600. So you tell me if that was favorable or unfavorable. I don't know, but it does make that difference.